Hello and welcome everyone. Thank you for your time. I hope you'll find this information to be very useful and you'll be able to make use of this to build your wealth faster. Here we are going to talk about how you can build wealth passively through real estate investment as a limited partner. That's a term we'll explain a little later, specifically in multifamily real estate, which are known as apartment complexes. So let's get started. Let your hard-earned money work harder for you. My name is Bani. I'm the managing principal at Mighty Capital, where we help investors build great wealth. A word of wisdom: a lack of knowledge creates fear, and seeking knowledge creates courage. And that's my goal today, to help spread the education amongst all of you so you are more empowered to make better decisions about your wealth. Some disclaimer: the information I'm presenting here is solely for the use of providing information, education, and training. And I'm not a certified financial advisor, neither I am a tax advisor, nor I'm an attorney, nor I'm a CPA. Please consult your attorneys or CPAs or advisors before you make any investment decisions. So I have been talking to my friends about this recent experience I just have had. I invested passively, and since then I felt that I must be sharing this with my friends, that hey, there is something like this and it might be helpful for some of them, maybe all of them. I just wish I knew this 20 years back. So now I'm being a good Samaritan. I'm spreading the word so you can make use of this information, educate yourself, learn more, and build wealth much faster towards your financial freedom. Of course, I have my big dreams. I'm getting interested and feeling confident about moving on to the active side of this, the active management side of such deals. But I think the bigger impact I'm going to create is by helping the friends and people I know in my circle to build wealth and achieve financial freedom. So this is why I invested passively. This is a single slide to summarize my whole experience. So after my initial education and networking, it's essentially like, you stay passive. Usually the projects I have looked at, they are 5 to 7 years. And the risk aspect of such projects, they're mitigated at several levels. At least that's how I understood. For example, careful sub-market selection and due diligence by the deal sponsor. These are the people who manage the deal so that most of us can stay passive. You can look up this website and find out more about how to understand about a sub-market. The commercial lenders, they have a high standard of underwriting. They will make sure that this is a good deal because it is not just your money. It's a lot bigger money from them which is going into the deal, about 2/3 of the whole deal. Large number of tenants. Typically these projects are like anywhere from 100 plus, 150, 200, 300, 360, those kind of volume. So the vacancy risk on the net operating income, or NOI, is much lower. And typically in this kind of deals, maybe you'll be pitching in along with 300 plus other accredited investors who themselves are educated and evaluating the pros and cons, the risks and returns, and then deciding to put in the money. So only when all these 300 people have done their risk assessment, the project gets started. So a big amount of risk gets mitigated there. I felt good about it. And of course, as you look into the track record and the past performance of these general partners or these deal sponsors, and you find out from their past investors, you establish a relationship with them, you talk to them, you'll feel pretty comfortable like how their past performance have been. Usually, you're looking at a very high return of investment. The projections are usually like a 15% IRR. I have seen it going up to like 16, 17, 18, and some, aggressive projects could be much higher. IRR stands for internal rate of return, which translates to something like 20% average annual return, or AAR, which in plain and simple terms means 2 times the money you put in 5 years. They're all synonymous. So for example, if I have put in a $400,000 into a project passively, I'm looking at making $800,000 to $1 million in 5 to 7 years. Which again, when it matures, the project is complete, I will take help of things like 1031 exchange. That's a tax policy in case you do not know, and invest somewhere. And all along, I'll be enjoying cash flow. So again, in our example, a $400,000 investment typically will generate about $40,000 per year. And of course, when I pull out this money, put it in the next project, that time I'm looking at $80,000 to $100,000 per year cash flow. That's a pretty good deal towards your financial independence and dumping your probably 9-to-5 job. Relax, have vacation, spend more time with family, passive income. And another thing is, in such deals, when the deal is formed, I'm the owner, a part owner of that LLC. And of course, I have my rights and restrictions. But I own equity in the property. And that allows us to take a lot of tax advantages. End of the year, you'll be getting a K-1 tax form, which usually has very large component for business expenses and depreciations. So you get to keep more money in your pocket, more usable money, unlike, capital gains in stocks. That's a very big thing. No other asset class other than real estate has this kind of advantages. So I hope I got you guys excited. And again, I just wish I knew this 20 years back. I probably would have been sitting on a ton of money by now. But better late. So that was the summary at a high level. If you're in rush, I think you know what it means. But stay along and we'll go a little deeper, and few of the concepts will become clearer. Or, if you have more questions, hold off on those things all the way till the end of the presentation, and then we'll take on questions. Okay? I would like to get started by pointing out few headlines about the macroeconomic status of the country, as of recent times. I'll not read through all of those things, but as you know, Democrats are proposing a 2% tax on stock buybacks to offset their $3.5 trillion budget plan. And Goldman Sachs taps public markets to bet on private equity. Jobless claims declined. Job gains faltered in August as pandemic concerns grow. Many high network individuals are thinking about betting on commercial real estate. And there's a survey by Barron's readers. People who are high investors, 41% said they have become interested in access to a wider access of assets after going through the COVID pandemic. There are labor shortages, which is disrupting many parts of the economy. Marcus Millichap, this is another commercial real estate big company, points to signs of improvements in retail, hospitality, and real estate. The government is running out of funds to meet its current legal obligations, and home sales rise again, but prices may finally be plateauing. Specific to multifamily trends, we are seeing the occupancy hitting an all-time high of 97.1% as of August. Again, single family is doing good, and the number of active listings among for sale homes remain far below normal. The Delta variant has reintroduced some degree of caution and uncertainty. Apartment retention rates surge to near lockdown era peaks. Multifamily development rebounds faster than expected. Invest Corp buys apartment portfolio in the Sunbelt for $420 million. Former executives from the CBRE, which is another commercial real estate firm, they're going to invest in multifamily developments. So you can see, a lot of sharks are taking more attention. And of course, Supreme Court strikes down federal eviction ban. Why invest in real estate? I think by now many of you probably know, real estate brings a lot of advantages. But broadly speaking, it has been found to be more stabilized historically than stocks and mutual funds. Especially multifamily real estate usually returns 14% or more, and pretty resistant to recession. When comparing volatility and delinquency to other assets during, remember, this 2017-2009 crisis, this asset class proved it, that it is very low risk profile. And last year, the delinquency was 90% lower than the other residential real estate investments. Of course, tax advantage. History shows millionaires and billionaires built wealth with real estate. So yeah, consider real estate. It's a very good diversification, but specifically, let's talk about multifamily. A good way to kind of show it would be to draw a comparison, because most of us probably are, have our homes. So you kind of know how the single family works. Let's compare that to multifamily. When I say multifamily, I'm not counting those duplexes or fourplexes up to 4. I'm talking about the larger ones. For example, on the upward of 100, 200, 300, like that. Remember, economy of scale. The tax advantage in one side for the single family is linear depreciation for 27.5 years. You must be taking that on your tax filing. If not, go and take a look. Talk to your CPA. But in multifamily, you get multiple tax advantages, especially the accelerated depreciation, where you can quickly depreciate some things. And it's a big money. It's not small. It's not like onesies, twosies. It's like magnitude orders more. Valuation is done differently in multifamily. It's not like how much price your neighbor's houses are selling for. That's not what decides multifamily valuation. It's based on net operating income, in short, NOI, which essentially means total income minus total expenses. So the projects which have a project plan which proves that with high confidence they can increase the NOI, that means that's a good thing. That at the end of the project, 5-7 years, whatever it takes, it will be valued at a higher price, and that's when your equity will be multiplied and you'll make a lot of money also. The loan types are different. In residential, it's a recourse loan, a 30-year amortization, 30-year term, fixed rate. In commercial, it's non-recourse, so it's against the property. Again, all kind of terms are available, fixed rate, interest only, all kind of things are available. So when you analyze a deal, you should look at that and see, ideally you want those to be kind of fixated for the so-called 5 to 10 years. So that's not like a moving parameter. Management, either you manage it yourself in single family or give it to a property manager, but here it is done by professional companies. We all have lived in apartment complexes in the earlier part of our life, I guess. So you know, right? You know how sophisticated those are, and we have also seen the challenges and the value they add. Things are streamlined. There are people taking care of things for small problems. There are a lot of different services provided by them. So that's a good thing. In multifamily, we engage professional property management. Involvement, if you're passive in multifamily, nada, nothing. But if 300 people are passive, there must be somebody who's active. And those are the general partners. Those are the deal sponsors or the operators. And they're active. It's like their project. And funding, of course, you know how to bring your cash. But other than that, there are options available. Like, for example, you could tap into your other savings, like IRA. I have a slide later to talk about those. Okay? Again, to summarize, why multifamily? Return on investment, risk resilience, leverage. For example, you are putting $10 million, and with that, bank gives the rest, and you are purchasing $40 million property. And when you depreciate that $40 million property, you get a lot of tax advantage. Market demand, population growth, declining home ownership. So if the sub-market is chosen well, you know, you're all set for success. Real estate appreciates. Number 6, appreciation and amortization. Real estate appreciates in value, and of course, during the lifetime of the project, we paid on the mortgage, and equity is created, just like it happens in your single family. And with more equity, investors are expecting more return. So I think you can read some more things. I'm going to skip those for the interest of time. Typically, good projects will target the top markets with some strong apartment fundamental and landlord friendly laws. And these are some of the pillars which are used by the deal sponsors or managing principals to pick and choose the projects they're going to be chasing. So for example, there must be strong employment drivers providing stable rent income and lower the risk of investment by keeping the occupancy rates high. Supply constraints. There must be high barriers to entry in that particular sub-market. And the population growth should be sufficient enough to absorb any future supply. Typically, good projects will try to avoid markets which are nearing a potential bust, which are currently experiencing low cap rates. Landlord-friendly state laws. It's just so helpful to manage properties. Rental trends. Growing rents serve as an important indicator that the health and the stable economy is with lower associated risk of investment. And of course, we can look at industry data about occupancy trends. That signals that the growing population that is outpacing the current supply of new apartments. So, long story short, multifamily is here to stay for many years. In this slide, I'm sharing the research results from a very renowned personality in commercial real estate, Dr. Glenn Muller. He's from University of Denver, and he puts markets in 4 quadrants. Of course, most of us are probably going through a recession, phase 4. Then they'll move into recovery, and then they'll move into expansion, phase 2, and again at some point it'll grow into hypersupply. And this is the kind of cycle which goes and goes on. Of course, you can look for some of the states, and again, don't just draw a conclusion by looking at the name of a city or there, but because what matters is the specific sub-market. the 1 mile, the 3 mile, the 5 mile radius of a sub-market within a state. It drastically differs. This is not the only data, but this kind of shows like, how markets go through cycles. Okay. Again, an image I borrowed from internet. You can see the landlord-friendly states. Having said that, every market is different. So, for example, you could find a good balance of landlord-friendly laws and property tax and income tax and all those things, maybe somewhere like Phoenix in Arizona, even though it's somewhat blue. Red means landlord-friendly. Few terms, and you will be seeing these things when you analyze a deal. So cap rate, that's a very commonly used important term in multifamily. It determines an expected rate of return. It's calculated as NOI divided by either the purchase price when you're purchasing or the value. Net operating income, we talked about it, incomes minus expenses. DSCR stands for debt service coverage ratio. Basically, it tells the ability to pay debts. Banks look at that before when they approve a project. This act of forming a partnership like an LLC, which pairs the passive investors and the capital, the money, with the sponsor, this whole thing is called syndication. And when a project is pitched or brought about or shared with the interested potential investors, is typically shown in something called a PPM. It's a private placement memorandum. That's where you get to see what the projections are, what kind of property is this, what are the projected financials, and many other data. Why do the deal sponsors think it's a good deal before, so you should read those properly and ask a lot of questions. Non-recourse debt is a loan secured by the property, so they're not coming after you. Cash on cash is if you put in 100,000 in the investment, that's out of pocket, and if you get 10,000 per year, your cash on cash is 10%. Average annual return, so if you look at the total return in X number of years, and you basically divide that by how many years. IRR, another very important thing, internal rate of return. As I said, as a quick reminder, 15% IRR is pretty common in this kind of deals. Again, I have seen 16, 18, even 22, maybe more. I just haven't come across those. Again, it's always a balance between risk and return. So 15% IRR means double the money, essentially, in 5 years, which transfers to, again, a 20% average annual return. So, for example, if 100,000 becomes 200,000 in 5 years, that means 15% IRR. That means double. And that means you get 100,000 over 5 years. Return on equity is another indication where you basically divide the NOI over stockholders' equity, like how much equity was put in to buy this thing. Okay, who can invest passively in multifamily? Security and Exchange Commission has laws and rules to control these things, and they are constantly monitoring. They're everywhere. Okay, so if people are not following those things, of course, that will be the last deal they're doing. The career is doomed. So yeah, they have to be very careful in following these things. Yeah, and you all have to know. You must be an accredited investor, generally speaking, to participate in this kind of passive investment. These are like private placement. These are private offerings for where SEC forces you to follow some rules. For example, these projects cannot generally solicit or advertise things on open market. And number 2 rule is they can only sell the securities to only 35 sophisticated investors. It has a different definition. But for most part, the passive investors are accredited. You can Google these terms and learn more about it. But overall speaking, if it is an individual, he must be earning 200,000 or more a year. Or if it's a family, or with spouse, you should be earning like 300,000 or more a year, and that's what you expect to make for the next few years. Or it could be an individual whose net worth is $1 million without your primary home. So in either cases, you qualify to be an accredited. There has been some interesting recent amendment in August 2020. Take a read as this thing later when I share this video. It allows someone based on defined measures of professional knowledge, experience, or certifications, in addition to the existing tests for income or net worth. So look at those things. By the way, for 2020, it is estimated that there was 13.6 million accredited investor households in the US. This represents approximately 10.6% of all US households. And this number accounted for 73.3 trillion in wealth. So yeah, it's happening. And of course, people who buy security, they buy restricted securities, and the company is required to file a notice with the commission, Form D, so you can do search and find out about an LLC after 15 days of formation, but not before. And of course, there is this restriction about bad actor. You can read it up, basically saying that if somebody tries to do something funny with the money, they are going to be, nailed forever. Usually, another question is, how much money do you need? I have seen most of the projects, 100,000 or 50,000 as the minimum unit to buy one unit of the investment. That's how the offers open up. 100K. That's they try to minimize the number of passive investors because it becomes a lot of overhead for the accounting and the CPA company and a lot of cost. So they try to hit a balance, and that's why they normally go. I have seen some $25,000 unit, but I have found that those are not good deals. They are presented in a way with high numbers. If you do not know how to read those, you'll be easily fooled and you'll think that you'll make a lot of money. But yes, you'll make, let's say, double the money or maybe 1.8 times your money in 10 years. That's not what this market offers. This market offers better. So yeah, get better at analyzing deals. The process at a very high level. This is how it works. Number one, the deal sponsors or the operators, these guys, they are constantly looking at market. And when they find something from the listing broker, the good deals, they'll keep analyzing those, do some underwriting, give it back and forth. So that process is called, property analysis and due diligence. And when it gets to a certain point, parallelly, they keep working with the loan agency, and there are different types of loans, Freddie, Fannie, those are the popular ones, agency loans. Sometimes, there are other types of loans too. And this is an example. This is not a real name, Creekview Apartments, by the way. Anyway, so they do all this upfront work. Then they present it in front of the passive investors in the form of, PPM or OM, private placement memorandum or offering memorandum. These are all the limited partners. By the way, these active partners are also putting money passively. I'll feel good if my deal sponsor is also, his money is also at stake, because he'll be treated exactly like everybody else based on his proportion with these things. And of course, there's an operating agreement which gives the rights, what they can do, cannot do, and who can vote to achieve what kind of things. You should read PPM carefully. Overall speaking, you mostly stay passive. But if there's some wrongdoing, you can do something more. And these are active people. So once they kind of get a soft buy-in, they go and close the loan. And of course, they'll keep you up to date through investor relationship, about periodic progress, whatnot. And of course, quarterly financial reports, or they'll be disbursing your cash flow every quarter. End of the year, they'll helping their companies or their CPA firms will give you K1 tax forms. With that, you'll be able to take advantage of the expenses and depreciation. Remember, you have an equity in the real estate. So it is like you're doing a real estate business, There are expenses, there are depreciations, and we accordingly balance that out. So it is not uncommon to see the depreciation overshooting your cash flow. So it helps a lot of people by being able to take that depreciation and apply it to their, let's say they have another rental or another capital gain where they can do this. You cannot do this for your W2, by the way, unless there is something going on, which is called real estate professional status. That's a topic for another day. Once it is closed in the sense once it is bought, basically project management starts. And the term actually used is called asset management. So where essentially you manage the managers. So there is a property management company. These people help select them, interview them, find them, and manage them. Every day looking at the books, finance, and if anything is a red flag, they're taking actions. Remember, their goal is to achieve the projections they made, like what kind of NOI or exit cap rate they're going to do. That can only happen if they do this job well. Otherwise, NOI will not increase. And this is what you have also done. You have looked at their background, their past performance, the project itself, and the details they had laid out in the PPM, like what kind of tasks or actions they'll take to improve the value. Typical examples are things like, they'll probably put LED all around the complex. They cut the electricity cost. Typically, they'll try to see if they can build up a small storage and letting people store things, and they'll charge a storage fee. Typically, they'll see if you have, those old appliances, they'll start putting in, stainless steel appliances and raise the rent. So that's the asset management, and that's like a project plan you will be seeing before you sign in. So yeah, you are basically one level up manager. So these people shows a project plan you guys see, and when all these guys feel comfortable, only when they will fund in. And of course, when the time comes after 5 years or whatever is written in the PPM, they actually get active before that. For example, in some cases, it may so happen the market is suddenly swinging up. And if the projection was like making 2x over 5 years, and for some reason it's happening at the end of third year, these people are going to come back to you and say, hey, this is happening, and we are meeting our target. We suggest we sell it off and disburse the equity. And I think in most cases, this is a good deal because you can take that, do a 1031 exchange, put a bigger money in your next investment somewhere. You have been networking probably meanwhile and finding great deals as things are going to mature and you need to keep that. And that's exactly how people build wealth in real estate. You try to let the money grow and live off the cash flow, which is again tax advantaged. So that's the process at a high level. Hold on to your questions. As I said, let me finish some of the slides and then we'll take questions. I know we are kind of half an hour into it, just a few more. So if you're interested about what the operator is doing, at a high level, they're doing a lot of things. Ongoing networking with brokers, off-market sellers, finding a deal, underwriting, bank, loans, and of course, throughout the lifetime of the project to manage the assets, making daily decisions, running projects, doing risk mitigations, all kind of stuff you can think of if we have done project management in your, W2 job, what it takes. It's just a lot of money there, so they need to be prompt. So that's why they're busy. But they feel, it's very satisfying to see that, they're able to help so many people build their wealth. And of course, they get compensated too. So overall, they are busy doing sourcing, repositioning the asset, refinancing. Again, there may be better deals coming in. So in those cases, those things will happen. And again, such things will be spelled out in the PPM. You should pay attention to those. Maybe 2 years into it, they might find a good deal from the bank. They may decide to refinance and give some money back. So those surprises are good surprises. And of course, they'll always try to keep the rent going or they'll always try to keep the expenses down because that's how they increase the NOI. And that's how the property value increases at the end of the project. That's how more money is made at the end of the project. So what can you do as a passive investor? What's next for you? Again, as I said, get educated. Get more educated. Continue learning. That's the key. This is a book I read and I got interested in this. I think this is a very easy read. Passive Investing by James Kandasamy. He is a very well established deal sponsor. Most of his projects are in Austin, Texas, San Antonio, those areas. He's currently my mentor. I'm learning a lot of stuff from him. And learn as many asset classes so you can diversify. This is not the be all end all thing. But if you get educated on this thing, you'll realize how much can be achieved here. And then you decide. Like I decided, I'm excited to do this thing more actively. So I'm moving on to the active side of it. By the way, I'll continue to invest passively because all the wealth I make, I'm not going to spend all this money in one shot, right? So I need places to keep investing them and keep growing them, just like passive investment. So I'll be equally networking with many project deal sponsors so that I can continue to invest my money. Again, I'm there to help. I am on a mission to educate people, to help people learn this thing. And down the line, I plan to educate myself on many other asset classes. So I have this Facebook channel, Learn Passive Investing. Please come subscribe. You can join in many meetups, Facebook groups, podcasts, YouTube. There are many resources. Search for things like multifamily investing. And keep networking with deal sponsors. You'll find them. Once you hang into some of these Facebook groups or meetups, you'll see who is a deal sponsor. You'll figure out. And of course, sign up on these websites. The first one is a mightycapital.biz. I'm a managing principal there. Achieve Investment Group is by James Kandasamy. CRIpartners.com is another partner of me. So yeah, sign up. And there are many more. You can just go and search for multifamily investing and you can get started from there. But keep learning. And I think I'll be offering more webinars on different subtopics. I'll be repeating these sessions. So in case you think this will be helpful for someone you care about to help build their wealth, please do tell them. Please have him or her join and we can repeat this session. And I'll be glad that, if I can make positive change to people's life. How do you analyze deals? That's a big deal. Again, goes back to education. Read books, blogs, form small clubs or small friend groups. Discuss about deals. Let the deal keep coming and, analyze those, practice those. Understand key financial terms like IRR, AAR, NOI. I explained some of those. And if you stay plugged into the Facebook group, I'll be picking up things and explaining things, participate, ask questions, help the community grow and be savvy about this thing. And review a lot of PPMs and OMs offering memorandums. And remember, if you're part of some network, you cannot be disclosing those because you'll be under NDA till the project is filed through a Form D in the SEC. You are bound by those things because that's a deal in progress. And remember, public advertisement is prohibited when the deal is in progress. If you want to know more, go to SEC, Security and Exchange Commission, search for 506B. You'll find out more about it. Why so? And of course, know the deal sponsors, know them personally, understand them. It's your money. And of course, talk to their past investors, reach out to them, ask questions, build up relationships. I can help too if I. At a little advanced stage, when you are comfortable looking at the numbers, you need to look at many different numbers presented in the deal. I won't take you through all the numbers here. When you get the recording of this webinar, you can pause and watch. But these are some of the average numbers I have seen. Again, every single deal is different. You should definitely look at the final cash flow to passive investors or equity investors, the IRR, the project level IRR, and the definitely the post sale equity gain. So, but these are some of the things you should keep in mind. Okay. This is a checklist which you can read later. and get educated, and what to ask to the deal sponsors. These are things I learned and I from many other experts. So go through those things when you have time, and please do those things. You see on the top of this thing, I put something like, do you have trust for the sponsorship team? Do not invest in someone you just met. How professional they are. Track their record. Have they done something like this? Or has the group of partners done something like this? How confident are they doing this kind of deal? So look at those things. How do they treat people? How do they, so those things, because, that shows how they will be after the deal is the project is purchased. And of course, when you review the PPM and OM, make sure you look at those clauses. Contingency plan. What if one of the sponsors get hit by a bus? So think about everything. This checklist will come handy. It's your money. You worked hard. So make sure you spend researching before you invest. Just imagine or remember, how much time did you spend when you bought your last car? This is way more than that. So do not expect a shortcut. And with time, you'll become more savvy. And I'm going to be there on your journey to offer you more help, get you educated. If I don't know, I'll ask in bigger circles and find the answers. One other thing, in real estate, mostly, your money is not liquid and is tied up for many years. Having said that, you're still getting a good cash flow component every year, or actually every quarter. So yeah, semi-liquid, I say. A common question, I don't have money. Yes, I was in a similar situation before I invested passively a few months back. Hey, if you have old-fashioned cash, great. Savings account, you know what you're making in savings account. Upcoming bonus plan, if you start educating yourself today, you probably should wait for 3-4 months, unless something really good comes up and you vet it out, but it takes some time to get educated. Diversify from your low return, high risk funds. See if your primary home has has equity. Take some HELOC. There's a new thing called home equity co-invest. Look up that term, where it's essentially almost like a HELOC, but lot less paperwork. There are third-party companies who will give you money, a certain percentage of equity now. In return, they'll take back some equity after X number of years, typically 10. IRAs. I had no idea, and I'm sure some of you may or may not have. Self-directed IRA is a term. One could make use of that. It only took me a few weeks to figure out the tax implications because of unrelated business income tax, or UDFIs. You can read up IRS 598. There's some penalty you pay for taking money like that. Actually, what is a better path is QPR, or solo 401k. Look up this term. I'm not a tax advisor, and there are a lot of things available in the market, in the internet, to get yourself educated. And if somebody is from Texas, there are some special things you can do with 401k, and there are many more things, and we can probably talk about these things in our Facebook group. So if you have ideas, please share. Okay, and remember, you building wealth does not have to come at a cost of other person not building wealth. We all can build wealth together. Few quick slides. Again, I'm not a tax expert, but this is what I have known so far, and they are so great that I couldn't help sharing. So I'm sharing those. Take a read. Essentially, few tax laws. By the way, you can no way evade taxes. That's illegal. So never think of that you'll not pay taxes. What you can do is you can take help of the law, what law allows. So if you are working with a good CPA, he should be telling you all these things already. If not, read up or change. So one of the biggest and best real estate tax shelters for rental property owners is depreciation, because properties, not the land, the improvements, it depreciates over time. So for example, a multifamily property, $500,000, these are fake numbers, would have a depreciation expense of $18,182 per year because you divided that with 27.5. So if the property is generating an income of $80,000 per year, your tax obligations would be something like this. Tax owed without depreciation would be, this is assuming that you are the only person investing here. So tax depreciation would be, or taxes owed will be like 25%, assuming that's your federal tax bracket, $20,000. And with depreciation, you'll be paying $15,455, just straight $5,000, advantage. The property owner is saving $4,500, without including any other deductions. Remember, we have more. You can reduce your tax obligations by writing off expenses. So through expenses, for example, insurance premiums, management costs, maintenance, repair expenses, mortgage interest, utilities, market costs, these are all the business expenses. So this also proportionally will get reflected on your K1 because you are doing real estate business. In a small part. Smaller taxable income means smaller tax burden. Take a look at these slides later. Third thing is cost segregation, or basically accelerating some of the things, and this is typically being done by the multifamily projects because they're big in size, they can afford an engineering company to come and help. IRS allows certain things to be expensed like this. For example, you can write off like cabinetry, fixtures, appliances over 5 years or 7 years. And here's an example, same thing, 500,000 property fitted with appliances, fixtures, cabinetry worth 100,000. Now, if you look at the calculation, total depreciation expense, remember what you had last time? Now, total depreciation expense is 28,000. Okay, and Tax Cut and Job Act, which was, which came out in 2017, that adds a lot of other good things. 1031 exchange benefits, you make money, and then what do you do with that? In order to avoid capital gains, you invest that in another better project at the end of this project. So in the passive income benefits, there are few others like this. So for example, if one of the spouse, or if some of you are not working, you could try to get a real estate professional status. There are some rules, and you could save a lot of money, even your other spouse's W-2 job. Again, I'm not a tax advisor, but there are possibilities. One common thing people ask, hey, we have this REITs, real estate investment trust. So how does it differ? Here are some main differences. In REITs, you just do a blind funding. Your projects, your money is going and working on some project somewhere. Here, in this one, in multi-property syndication, multifamily syndication, it's on a specific property. You know which one it is because you'll be given that information upfront. Ownership, like in stocks, in REITs, but here you are a limited partner directly owning the property. In REITs, anyone can invest quick, $5, $5,000 here. But in syndications, it's a private offering, means no general advertisement. You must be knowing the deal sponsor and vice versa, and only accredited, and it takes some time. Here in syndications, you have high investment minimums, as I said, $50,000 or $100,000. In REITs, you can withdraw money, and here you cannot easily. For the REITs, you just get dividends. So again, no tax advantage. But here, massive tax advantage. Keep more money in pocket. We talked about that. In the last 40 years, total returns on exchange-traded US equity REITs have been averaging 12.87% per year. And here in multifamily, when factoring in both cash flow and profits from the sale of the asset, these investments typically offer 20% plus AAR, annual average return, which essentially transfers to double in 5 years. Plus, how much of that money you're getting to keep in the pocket? Tax advantage, depreciation. Some of you asked this question, hotels. Hotels is not real estate, it's actually a business. So buying hotels is a business. Hotel valuation is not like the cap rate and NOI calculation. it is on a revenue multiple basis. I'm not an expert on that yet, but if you are interested, you can look up. Hotel is also risky as it goes up and down with economic cycle. Hotel will take at this point another 2 to 3 years to recover. So if a project is coming your way, think about these things. Again, start in Google. Just put the terms and look for it. And in hotel business, there is no depreciation benefit. And again, that's a big incentive for me, at least for me. Now I have a bunch of case studies. I'm not going to go through those. I'm just going to quickly gloss through those. And I leave those for you so you can look at those things. So a year from now, you may wish you had started today. Take action. Get educated. That's the first step. You can contact me. That's the website. So essentially, what you